talked about the lie of leverage. We talked about stops. And I'm going to do one more thing on stops, and I'm going to point Mike in further directions of where he can go. So let's go here. And we're going to go to, I'm going to sign out here, though. Hey, sign out. We're going to go to radioactivetrading.com. We're going to go to resources. We're going to go to the trade simulator tool. What this tool does is allows you to put an expected target return for your position in, I apologize, it's William, right? William, I want you to go here later and try this out with your numbers, okay? What do I mean by that? What is the return I'm expecting on a covered call trade? Bull put credit, bear call credit, Iron Condor. How am I going to control my loss? If I close a position for loss, I'm going to close it at 20%, I'm going to close it at 30%, I'm going to close it at 50% of the maximum loss. Where am I going to put it? Probability of loss. Well, I'm doing the bull puts, it might only be 15% because I'm looking for an 85% probability, or 20% if I'm looking for an 80% probability between. Starting amount and invested per trade, right? So for my bull puts, what I typically look for is a return of about 15%. Really, I've averaged about 14.9%. I'm going to control my losses to 50%. So like we just showed in the Iron Condor, William, you had a $4 maximum risk on a potential $1 profit. Well, that was a 25% expected return. And the loss limit, if you're setting at 50, means you'd close the position if you hit $2 closing price of the maximum $4 you could lose on the trade. My probability of loss is going to be 15% because I'm looking for the 85% probability. You're looking for 80 or 75, you'd put in a probability of loss of 20 or 25. I'm going to take $10,000, and if I had a $100,000 account, 10 to 15% of it, $10,000 to $15,000. But I'm going to open 3 trades at a time. I'm going to allocate 33% to each trade. What this tool did is flipped a coin 100 times. Heads, you win. Tails, you lose. You can see the number of wins, number of losses based on the probability of loss you set, high value, low value, ending amount. Now this one is unrealistic because we had a string of 15 winners in a row. Possible, not likely. But as you go, wins and losses, you can see the effect. Let's just run the simulation again. Okay, now that's 90 to 100. That's not what I want. Stay at a 90. There we go. This one's more realistic. What did we do? After 100 trades, 100 bull puts, trading 2 to 3 every 2 to 3 weeks, averaging 14.9% return, closing the loss of, so I'm allocating 3,300 to each trade. If I hit a loss, we close it out for about $1,500, $1,600. Okay, $16,500. $1,650. Wow. Sorry, folks. $1,650. Okay. In this scenario, in this mathematics scenario. And as you can see, it starts to build. We have strings of winners and losers. At one point, I am down 37%. And I expect that with this structure because of the lie of leverage. It's not going to dissuade me because as long as I keep the win ratio where I want it, and usually mine's at 84 to 87, a little bit higher, but yeah, let's call it 85.3. Then I'm going to come out ahead in the long term, but I'm going to have wild swings up and down. Waylon, that's going to see you with your Iron Condors as well. Let me put this back up to 15 because I want to illustrate 2 things very quickly here. This is what you might expect with an 80, 85% credit spread. 15% return. We're going to control losses to 50% of the max. Hey, 86% win ratio. We took $10,000 up to $51,000. But at one point, we're at a 44% loss. Common. Expected. That's the lie of leverage. Mike asks, what do you recommend for stops, stop loss orders? I personally don't use stop loss orders. As much as I say that I can't make my trades directly because I'm on coaching sessions, writing new content, doing new webinars, I'm not going to stop a coaching session to make a trade. I'm not going to stop a webinar, absolutely, to make a trade. I'm not going to stop a phone call from a customer that's not even a scheduled call to make a trade. I set the alerts on power options and I go in and make the trades because I don't want to get filled at market order on a stock that's wavering against me for a credit spread, leap position, or leveraged ETF that's extremely volatile. I want to try to get control of the midpoint, even if I miss it. But again, That's why I'm doing more conservative strategies, because even though I am on the screens all day, I'm not in the market trading all day. But what triggers what I use to consider a stop, Mike, for credit spreads? Well, I've got 3 of them, and we're going to show you the presentation so you can get full information about that. The stock reaches within 1% of my short option strike price. In other words, if I did a bull put, I probably started out 6-7% out of the money. But if the stock moves against me, 1% of the short put strike price, I'm considering rolling, adjusting, or closing the trade. I hit this, I'm out. We'll straight Y in a moment. If the stock falls suddenly and I have to close the position because it's 50% of the maximum loss I could take on the spread position, I'm gone. Not even going to try to manage it. Okay, once or twice I've managed it, but usually I'm just out. The other thing is technicals. I typically would open a bull put when I have a positive MACD crossover, positive MACD signal, stocks above the SMA 20, blah, blah, blah. We're doing our little tick marks here, and it's up here, and there's our 20-day moving average, and this, and all that stuff, yeah? Okay, so now if the MACD turns negative for my bull put or the stock falls below the SMA 20, I'm starting to look around for reasons why. Is it the market? Is it my stock? Is it something else? And I'm considering management techniques at that point because I can't let it go to where it does fall below the SMA 20, the MACD goes negative, hits the 1% rule, and this goes up to 60%. Why? Take a look. 86% win ratio, low value, 5,600 with a $10,000 account. But, wow, ending amount after strings of win and losers. It's a simulation. I know this is not a guarantee of what to expect, but it's giving you a mathematical simulation. What if I kept the same win ratio? It's random every time, but we're going to go 86-14. But I allowed the losses to go up to 60%. Just 60, just 10% more. 87 and 13. Well, first off, you can see the ending amount is well below the 51,000 in the other simulation. But let's get to 86. It's random every time. That one's not too bad with 85 because you only took a 20% drawdown, but you're less than half the ending profit because of the loss. The win rate's the same. The success rate is almost the same. 89.11. Okay, I'm trying to get 84 there. Yeah, so now it's only at 16,000. That's still fantastic, but 37 drawdown. You're allowed to go to 75. Still making 15% on your winners, still with an 85% success rate. Same allocation. Yep, 89% winners. Let's get to 86. Come on, stop going high there. Don't go that low. There it is. Still a drawdown of 30%, but the max expected return is 11,000, 12,000 compared to 51. And once in this range, see, oh, I was surprised. This would usually have gone bankrupt. If you don't get the win rate you want. Yeah, see here, you're 81 winners with the strings of winners and losers. Again, random every time. You're down 83%. I'm sorry, 86%, 87% by not controlling the losses. Let's put it back to 50. Okay? Now, Michael, let's say that this, oh, sorry, not Michael, William, let's say that this was your Iron Condor. Making 15% return. 50. This is, you're running the scenario to sort of see, hey, what mathematical numbers do I need to be successful to hit my targets? I know these were started where mine are, and that's what I'm looking to achieve. But now you say you're not over managing. My apologies, William. You're having to trade more to move up and down, left and right. And you say that you're only making a third of the expected premium with the commissions and the constant rolling, which means you still have the same numbers, but your trading plan of making 15%, maybe in your case it was that 20 to 25% with a 70% probability of profit. Your numbers would change, but look, you saw the success rate we would have with those numbers. Now let's change it to just the 5%. Even keeping the 50% losses, I'm losing money long term. 87% win ratio. I'm targeting 15, but I'm only making 5. I'm only making a third of the premium, a third of the return with all the management I'm doing. I am nowhere near where I should be. I am not meeting my goals. I'm losing 60% of my profit long term. And you could say, okay, what if you're probability of loss was 30%, but you were targeting 30%, so 70% probability, which means you're forcing your returns closer to 30%, but you're only realizing 10. Well, see, if you do the 30 here, yeah, you're doing phenomenal. Even with a 72% win ratio, you're doing great. These are similar to the numbers that I had. A 65% win ratio, still doing great. But you're only making 10%. You're not making the 30. You're making a third from what you said with the management. Not going to be successful long term, sorry folks, even with the 73% win ratio. So try not to get bankrupt. I'm trying to get up to, like, there we go, 75. Even with a 75% win ratio, $1,200, strings of winners and losers, controlling the risk. So you say, oh, well, let me lower the risk down to 30%. But if I keep going the loss limit lower down to 20, 25, 30%, you're not making 75% because you're closing more of the winners more frequently. That's the tough part, all right? So in this, without making 10%, controlling my losses to 50, I can tell you right now, I need a win ratio of at least 87, 88%. There's 93. That's what we saw. 90. Okay, still looking pretty good. 89. That's about right. But you'd have strings of winners and losers. 91. That's not going to get it because you need to be right 87, 88% of the time. And that's kind of what we're seeing here. Okay. If you're only getting 10% return, third. Okay. Well, spread. This is for any spread trade. Now, I mentioned it as Iron Condors. This is the same if I was just doing bull put credits. This is the same if I was just doing bear call credit spreads. The lie of leverage. That's what we just illustrated in action. You can't let the losses get too high, but you've got to set a structure for a realistic trading plan, because going for the lower probability to go for the higher return only works if you're able to get that. But if you're managing too much, you're rolling too much because of the wild market where the stocks are moving up frequently, stocks are running, volatility, AI, things of that nature, and you're only getting even half of that. See, my numbers, if I'm averaging 15% return on my investments, on my weekly bull puts, still controlling the loss to 50% of the same allocation, but only 70% success rate, bankrupt. 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 Oh, idiot. Let's do that correctly, William, shall we? There we go. That's much better. Okay. 64, bankrupt essentially. 71% success rate. Nope. 69, nope. 79. Hey, I made a profit of 3%. That's not your target goal after 100 trades, William. I know it. Okay, but you're right 79% of the time. If you have a 70% probability, you should be targeting a 30% return. You said, you're only getting a third of that, which is likely 10% of the risk involved. I gave you 15. I gave you half. Still nowhere near what you're going to be. You're treading water long term. Yeah, you can even think I've got a profitable return on the position. You don't. All right. While I'm here, William, and while you can go this weekend and play around with this tool, I'm going to encourage you to get the sketches, that free introduction, 9-page white paper to the blueprint, the full course that discusses the married put and the 12, 13, 14 different income methods as well. It's under the products link. Power Options bought the right to radioactive trading from Kurt Frankenberg a few years ago. Kurt Frankenberg originally developed that. So, Mike, we talked about the credit spreads, talk about the leaps. Here, since we're already 2 hours into the presentation, here's what I want you to do. Mike D, what do you recommend for stop loss orders for credit spreads? Well, I gave you the rundown of 3, but here's what I want you to do. Go to Power Options, the YouTube channel. Click on playlists, or you can go directly to the strategies you're interested in. Let's say bear call credit, bull put credit. I'll go bull put credit home. You'll see the link to the YouTube bull put playlist. There's about 10 or 11 strategies discussed here in the playlist, and each strategy has about 10 or 11 videos, right? And for bull put credit spreads, here we are, bull put or bear call credit spreads, and all the strategies, these 9 to 10 videos are designed to walk you through from step A to step Z. Sometimes I say step 1 to step Z, or step A to step infinity. But credit spreads, the basics. Beyond the basics, part 1. Tools for credit spreads, bull put criteria, finding trades, what criteria we look for, a lot of mention on what I just talked about, the 85% probability, comparison of spread ideas, 2 ways to trade going forward, 8 ways to manage a bull put credit spread, clarifying suggested stops on the credit spreads. It's only a 13-minute video, and it discusses what I would look for a bull put credit, bear call credit as a trigger point to roll the position, which also applies directly to Iron Condors because I'm doing 2 credit spreads. Leaps, and I'm assuming by leaps, Mike, you're referring to the diagonal call, calendar spread, poor man's covered call. Full playlist on that one too. View of diagonal calendar, poor man's covered call, guidelines, importance of the debit to strike difference ratio criteria, managing the sold call, rolling a deep in the money calendar, and fixing a broken calendar spread. So other management ideas. Oh, shoot, trigger. I didn't want to click that. Don't start. There we go. Okay. Close, please. Fantastic. All right. And leveraged ETFs with high volatility and low volatility. Same thing I would use in any other structure, Mike, meaning that I don't trade stocks directly. I don't trade, I wouldn't buy just an ETF, swing trade an ETF, low volatility or high volatility. Anything I do with a long underlying securities with options one direction or another. I might trade a bull called Debit Spread on leveraged ETF. I might trade an Iron Condor on an ETF. I might do a long straddle or strangle on a leveraged ETF, Mike. But I'm going to use the same stops and the same triggers I would use in that strategy, regardless of the underlying security. Okay? So, I don't, the best thing I can say about the leveraged ETFs and stuff is if you're just buying stock, you're trying to swing trade, I'd say follow maybe the same rules that you'd use. If the trend changes, make an adjustment, not saying switch over directly, but make an adjustment, hedge it. Just buying shares of a leveraged ETF or low volatile ETF, you can always follow Bill O'Neill's possibility. If the stock falls 7%, you might want to look to close the position or get out. Don't allow it to go any further. Why? The lie of leverage, same thing. You can't let the losses monetarily outpace the gains percentage-wise. Gambler's ruin. Even in long securities, okay? And low volatility ETFs, you're buying and selling, that kind of thing. Just what you would use for a standard stock position. I wouldn't change the stops that you would use in those cases. But if you're talking about, trading a condor or trading a debit spread or a credit spread on leveraged ETF, high or low volatility ETF, I would use the same exact stops I use in the strategy for any underlying. I'm using the same stops if I opened an Iron Condor on SPY that I'm using if I opened an Iron Condor on Tesla, that I used if I opened an Iron Condor on NVIDIA. Okay? That's not changing based on the structure or based on the underlying. I am also default not trading Iron Condors on a Tesla or NVIDIA, or would never recommend doing it. But if I happen to find myself in one, then I'd use the same stop orders, Mike, that I would have used in other strategies. Debit spreads, call buying, bear put debit spreads, calendar calls, covered calls, naked puts, earnings discussions, bull put credit spread criteria, bear call credits, radioactive trading concepts. I think there's some Iron Condor ones down here too. I thought there were some Iron Condor ones down here too. How did I just miss that? I got to find that. I think I put a playlist together and didn't make it active because I know I have about 6 or 8 videos that are related to the Iron Condor and I'm not seeing them. I'll take a look at that for you. But in any case, that's a good place to start as the playlist for the discussion on stops, recommended management techniques, Mike, in those strategies. And again, just leverage ETFs with high volatility and low volatility. Depends on what structure I'm in. I'm not changing it necessarily. I'm not changing my adjustments based on the underlying. And that's not really a fair statement, I think, to say, only because my default criteria that I use for the strategies that I prefer, which we just reviewed, are all finding similar stocks. Some of these are a little, there's NVIDIA. I might just walk over this one and move to the next trade. Coin is a little bit more aggressive maybe right now. Step off that, move to the next one. But you see names that First Solar, DoorDash, a little bit more volatile. What am I looking at? 19, 18, 16, 15, 14, 13, 14% returns with 86, 88, 87, 89% probability above for 2-week out trades. I run this search typically on Monday. That's for me for the bull put credit spreads. But following what we discussed here in that bull put credit spread management technique and discussions and stops, clarifying the stops. Once I open once I open a bull put credit spread, if I open 2 or 3 on Monday, I'm going to put them in the power options portfolio. I'm going to put those stops in based on, did it cross below the SMA 20? Is it within 1% of my short put strike price? So on and so forth.